On behalf of the Financial Times, I'd like to welcome you all to this Insurance Summit. It's my first time here. I'm really excited to be here. And I'm very happy to see that 1 in 4 of you are feeling pumped. So let's keep that energy up through the day. We also really welcome interaction. So please do put questions in, starting now, into the app, and then we can kind of feed them in at the relevant points. So please, we want as much back and forth as possible. We want to hear what you're caring about right now. This first session is a great one to set the big picture for the day. We have 2 senior business leaders alongside me to talk about some of the biggest challenges facing the insurance sector and indeed the wider corporate sector. Today's geopolitical and economic climate is, as Arthur said, febrile, changing. You don't need me to tell you that. Surging inflation, deepening conflicts around the world, and very nervous markets. It's all made a kind of challenging time to be in the insurance industry, but also an opportunity for those firms able to and willing to absorb risk. So joining me to discuss some of these big themes are Orla Gregory, alongside me here, the president of Enstar Group. Orla stepped up to the top job in March. Previously, she was CFO, and she has a long career in the insurance industry in Bermuda, but also in Ireland. Alongside her, we have Kevin O'Donnell, who's the president and CEO at RenaissanceRe, the P&C reinsurer that he joined in 1996. Kevin has also held various roles in the industry, including former chair of the Association of Bermuda Insurers and Reinsurers. Sadly, Trevor Carvey, who's down on the programme, was unable to join due to a personal matter, but we'll forge ahead regardless. And as I say, welcome any questions from the floor throughout the session. Look, Kevin, I'd like to start with you, and I think the only place to start is geopolitics. The concerns about contagion from the Israel-Hamas conflict for the wider Middle East has piled fresh uncertainty on a sector that's already dealing with the fallout from Russia's invasion of Ukraine. There are also concerns around escalating tensions in other regions, namely China, Taiwan, to name just one. How is this, as an environment in which to do business, how are you thinking about this kind of heightened age of antagonism between the global powers and what it means for your business?
Thanks. The tensions in the world, such as those that you mentioned with geopolitics, actually are not, they run alongside the entire organization. They run from how you think about investments, operationally, do you have people exposed in areas that of increased risk of hostilities, and then obviously different coverages. So if you go back, and I think each time there is a shift in geopolitical tensions, look at Ukraine, there's always a bit of a surprise as to where risks can emerge from. So I'm not sure the expectation when we were thinking of Ukraine that we would end up having an aviation crisis. And I think there's also, as you look at the cold tensions and hot wars, you're constantly thinking about how to position the portfolio. So where do you want to take more risk in the investment portfolio? Where do you want to reduce risk in the investment portfolio? And then you're really, from the coverage perspective, on a prospective basis, you might make coverage adjustments. But the coverages that are in force are exposed, whether it be trade credit type policies, aviation policies, there'll be terror, there'll be political violence. So it's just something that from an organization, you need to remain diligent in the risk management and make sure that the risk management is comprehensive across the whole enterprise.
Has there been a fundamental shift, though, in how you're thinking about some of these war risks or geopolitical risks from before? Because obviously, every day comes with fresh news lines from Ukraine about risks, and you mentioned aviation, something that people hadn't really put a lot of thought in before, which is now making people quite nervous, and we're seeing aviation war insurers, take some of the same moves in relation to Israel. What's your sense of whether there has been a fundamental, whether certain risks were underappraised before?
Yeah, I think one problem with the industry often is the place that the industry first goes is exclusion. And I think what the industry needs to think about is what really is the shift in probability of loss. So how much has the curve elevated? When we think about it, what we don't want to do is sell an option. So if we're in a coverage or providing coverage that has potential exposure from geopolitical tensions, we want to make sure we charge for it. But we also want to make sure that when it's a policy designed to do something else, it's excluded. So we're quite happy to go into those markets or to continue to perform in those markets and provide people the protections they need. But we want to be very, very explicit as to the coverage that has been purchased so that there's no hidden option for execution later. And I think aviation in Russia, there were aviation war policies and aviation policies, and I think one of the tensions was there was a degree of optionality as to think about what actually happened and where coverage could be sought.
Yeah. I'm going to ask just briefly how you're thinking about Taiwan now. Obviously, it's a further off scenario, but insurers are already thinking about what happens in a scenario of escalating tensions. How am I exposed, and what actions would I need to take? How are you thinking about that part of the world?
So
about Taiwan in terms of any kind of exposure or running any scenarios on actions from China towards Taiwan.
Yeah, you're in this business, you're exposed in Taiwan, and if that becomes a hot war region, that's going to be problematic. But we monitor the aggregations there. We're very careful as to look at what can be exposed, and I think something like Taiwan, I think as you move out, you need to look at extreme correlation in the tail of the risk that you're taking across lines and throughout the geography of Taiwan, where and making sure that should something uncontrollable begin to happen there, you're not exposing your firm to too much risk. So you want to make sure from the investment portfolio to the risk portfolio that you're overstressing the tail with very high correlation among what otherwise would be probably separate lines and much lower discrete event sets.
Yeah. Okay, so stepping back to the bigger question, how are you feeling about geopolitical risk? How's it affecting the transactions you do as a legacy specialist? Does it kind of breed disquiet, or do people look to do more kind of run-off deals when there's the today risks on the table?
So I guess it is different for us in terms of what the geopolitical environment means for Enstar. I think just for the sake of everybody here, if I can just do 1 minute on what Enstar is. So we were set up about 30 years ago. We actually have our 30th anniversary this year along with RenaissanceRe. And we pretty much pioneers of the runoff industry. And I think originally, a lot of the transactions we did were addressing troubled companies or troubled lines of business. I think as the insurance industry has become more sophisticated, and I think we're all a lot more, we've evolved into more sophisticated risk management, those opportunities are less and less. And so we've evolved along with that, with the sophistication of the overall insurance industry. And so the type of transactions that we do now are more often about working with CEOs to help them implement their strategic objectives. And so the transactions that you will have seen us do over the last few years are more about capital relief, about providing certainty to older lines of business so CEOs can focus on the challenges that they're facing now into the renewal season. And it could be helping with rating agency outlooks. So that's kind of the side of the market that we service. And so we are not considering the risks in the same way that Kevin and other insurance companies will be considering them. How we look at how we can support the active space is looking at where is the noise coming from in existing underwriting years. And so I think inflation, and particularly social inflation, has certainly put a lot of pressure on existing underwriting years and reserving. And so that is an area where we can work with parties to design bespoke solutions for the particular challenges they face. We see more deterioration coming. I think the soft market in previous years has really added to that. So we can support in the back years and help the industry to face into what they need to do for renewals.
Yeah, that's great. And I want to come on to talk about some of those aspects of inflation shortly. Just on the kind of deal environment, do you see any transactions that get delayed? Because obviously a lot of the groups that you are transacting with do have exposures to the things that we've been talking about. Yeah, is there any more uncertainty that you detect, or does it not affect your corner of the market?
So we expect that it will deliver more opportunities for us because I think players will need capital capacity. They want to focus on the insurance challenges that are ahead of them. And as Kevin said, you don't want to be in a world where you're excluding the risks that need to be covered. That's the job of the insurance industry. And so we're quite anticipating a lot of activity in our pipeline.
Let's shift to talk about the economic environment then. Kevin, I'll come back to you. Obviously, we've had a sharp shift towards higher interest rates, expectation of higher for longer interest rates, and what's linked to that is this very strong period of inflation that has really hurt insurers on the claim side, but has pushed us all into a new monetary environment where it will have implications for insurers' investments, but also for their underwriting. Maybe if we start on the inflation side, what's your sense of whether it be social inflation, as Orla mentioned, or the kind of monetary side of things, as to like where we are right now and how the outlook is for that, which has been quite painful, particularly for primary insurers, but also for reinsurers.
Yeah. I think it is important to think about inflation and interest rates on a combined basis with the macro environment that we're in. I think from an inflation perspective, as Orla mentioned, there's two inflation inputs that are important. One is economic inflation, the other is social inflation. Economic inflation, I think it's reasonably transparent, but doesn't mean it's well managed. So I think, as TIBs change, it's not always reflected. So what happens is, with cumulative years of relatively high inflation, it's pretty quickly to get out of sync with one's insured value transfer, particularly to the reinsurer. So that can be painful as those things get reconciled back to appropriate values. And then on the social inflation is just very difficult to estimate and to manage. If you look now, and you can almost take social inflation and take out the pandemic years, which was a sharp decline, we're on basically the same trend of increase with social inflation as we were prior to the pandemic. So I think the sense that things have changed has probably been debunked, and there's a very real sense that social inflation is back and maybe even at an elevated rate of change. So that's the inflation side. I think it's very, very difficult to manage the social inflation. Economic inflation is relatively transparent, but can get out of whack, and then the true ups are painful. And then on the other side, you're leading, obviously to combat that is we're in a pretty constructive environment for investing. So I think the challenge right now is, as people are talking about higher for longer or we have peak rates, is to thinking about duration. So I think there's a tendency as rates were rising to pull durations in, maybe become a little mismatched on the duration of equity basis, and now looking potentially to stretch those durations to make sure that you capture what looks like a pretty healthy rate environment and the forecast for it to be, changing at a slower pace. So it's looking at the entire enterprise and looking where the elements of inflation are affecting you most, and then where the opportunities for investing are most constructive.
Okay, so pulling a couple of those threads out, on the social inflation side, what's your thoughts on the prospects there and the factors there? I know we've talked before about kind of court throughput in the US, but how confident are you? How difficult is it going to be? And I suppose the bigger question there is, obviously inflation has been a major factor in this significant rise in reinsurance prices that we've seen over the past 18 months. So the big picture question is like, how long is that going to be a big driver of prices going up, especially when reinsurers like yours are starting to make decent money now, and some might hope that the cycle is going to turn.
Yeah, I think, we think about it, obviously it's a bigger issue for casualty, so let's look at social inflation or legislative abuse. Either term probably works. And I think it's difficult to forecast. I think right now we are still, in most lines of business, have rate above trend. But over a 10-year period, if you look at what has occurred in that rolling 10 years, there still needs to be more rate to make that 10-year return adequate, because prior to 19, there's probably going to be some tensions in the loss curves that are not fully recognized yet. So I think that we're going to be in a very strong constructive environment for rating. I think reinsurers are in a very good position where we are playing quite a critical role to help companies catch up to where they need to be. And with that, there might be some opportunity for us to improve terms like ceding commissions as well.
Yeah, Orla, can I bring you in, especially on the casualty side? How do you look at it from your perspective, this challenge?
So I think that being at the cutting edge of claims expertise is pretty important when it comes to managing the exposures that are impacted by social inflation. So I think it is not an area where you can just sit back and process claims. You've got to think about, what are the trends, ensuring that legal firms are aligned to what you want the outcomes to be. I think you have to be very proactive. And so back again to Enstar can be the right place for helping insurers to get the right outcomes and to stop the deterioration.
Do you have any hope that any of the kind of legal reform efforts in the US will pull back some of that inflation? Or do you think those are kind of piecemeal, state by state, won't affect the overall picture?
You hope, but I think we've got to consider that this is here for now.
You agree with that? Yeah, and I suppose on the property side of things, rebuilding anything is vastly more expensive than it was, a couple of years ago. What's your thoughts about how those inflationary pressures are playing through? Because obviously that's part of a much bigger, important question around the insurability of certain, especially climate-exposed areas in the US and outside. What's your sense on where we are there?
I think we've always modeled inflation, so I think it's part of our model. I think one of what I touched on before is really are the inputs reflecting the accurate values, kind of as your starting point. But within our models, we are constantly adjusting our loss curves to account for inflation and demand surge inflation. So there's going to be elevated inflation after a hurricane in the environment in which you're looking to rebuild with labor and materials. So our adjustments for inflation are not linear. They increase as you move out to the tail quite substantially. I think it's been a while since I've looked at these in detail, but at the more remote return periods, the demand surge inflation is well north of 30%.
You talked a bit earlier about the investment side of things with the high yield environment that we're in now. Obviously that's putting stress on some insurers' investments. If they can ride out that stress, then they have the promise of kind of high yields on the assets they generally invest in. But what's your sense? We've had a significant step up, as I say, in yields. We've already seen, say, in the life insurance sector, some of that stress come through. But obviously all insurers are big holders of bonds and other credit assets that have been kind of marked significantly down, also have exposure to property, asset class, which has got some concerns over it at higher interest rates. What's your sense of the outlook there?
Yeah, I think there's two things to look at with that. One is what is the marks you're taking, what are the economic impact, and then secondly, what is your liquidity issues with regard to the portfolio. I think the rating agencies, I think, have done a good job looking to see whether these are time impaired. So they're going to pull it apart. You're going to get back to recover the marks, or are these credit problems? And I think they've been patient to see that this is the normal cycle of a changing interest rate environment. I think we spend and we do that as well, but then we'll spend an awful lot of time making sure we're really careful as to where liquidity resides, because of where the marks are and what the portfolios look like. So I would say keeping an eye on both, but I am pleased with the way the rating agencies and regulators have thought about it, recognizing that being patient and recognizing that these things should naturally come back if they're credit good is been pretty helpful to the industry.
Have you taken any asset allocation decisions off the back of this? You talked a little bit about duration earlier, but have you taken any decisions about where you want to be invested given this shift in the yield environment? So at Renaissance, we've changed the profile of the company pretty substantially over the last dozen years or so, going from a property cat portfolio where we were very short duration, very high liquidity, to having more of a blended investment portfolio with longer tail reserves. So with that, we have thought more carefully about duration. We still maintain a pretty conservative posture within our portfolios, though. And we have changed the way we've constructed the portfolios with the amount of credit risk we're taking and where we're taking credit risk. We keep the investment portfolio underwriting tightly correlated or tightly coordinated. So sometimes we're taking more credit risk in our underwriting platforms. Other times we're taking more credit risk in our investment portfolio. So we're constantly looking at that. And right now we're probably a little bit short on duration and a little bit de-risked with regard to equities. Orla, how about yourself on the investment side of things? Any impact on how you're thinking about your investments or the kind of deals you want to do in terms of like the business that you bring on and how it's back?
So I think similar to RenRe, on the fixed income side, it's been difficult with the unrealized losses, but helpfully from a regulatory perspective, we fare okay on the capital side, and it is just a matter of waiting out, getting to maturity and seeing those losses come back. On the risk asset side, strange times. So we have certainly looked at our strategic asset allocation to consider, are there areas that we would want to make a strategic shift? And I think when we started to look at that, we thought maybe there would be some material changes that we'd want to make, but we ultimately concluded that there weren't any. We made some tactical changes that were just taking advantage of opportunities, but overall, I think companies set their strategic asset allocation for the long term, and they consider, at the heart of everything is your risk management considerations. Yeah. And even though we have increased challenges, we're still in a situation where we're happy with our asset allocation.
Thank you. Kevin, maybe we kind of alluded to this earlier, but I want to talk a little bit about one of the big questions that definitely comes up in my reporting and in the frequent industry debates, which is the climate change and the impact that it's having on property catastrophe reinsurance, and then the wider implications of that for people's ability to insure their properties and homes throughout the world, especially in those places most exposed to extreme weather. There seems to be a spectrum between people that think at the most positive end, this is a cycle, insurance prices have risen, at some point the sector will be able to absorb more risk again, and there'll be adequate compensation for that risk and everything will be fine. And then people at the other end that think we are very much in that scenario that people have been warning about for years, which is that big parts of the world are becoming increasingly uninsurable, and this pullback that we've seen from the reinsurance sector through higher attachment points and high prices and trying to reduce exposure to things like secondary perils is only going one way, and actually this is a structural problem. There's going to have to be more public absorption of that risk. Where are you on that spectrum? How do you think about this question?
We've modeled climate risk for a very long time. We've got 25 scientists dedicated to understanding how we think climate is changing. So from a modeling perspective, I think you take the UN report with likely changes to frequency of hurricane, and I think there's generally good agreement as to what the future state can look like, and it's certainly a world with more elevated risk. I think there's a lot of confusion as to what the climate ramp looks like from today to that future state. So we spend a lot of time trying to estimate how the world is changing to what is probably relatively good agreement as to what the world will look like. I'd say, nature has been probably ahead of science. So if you look at what's been happening, so we're constantly, trying to not be on the curve, but be a little bit above the curve so that we're thinking about where the risk is headed. I think to your point with private and public partnerships, though, if we take, risk is elevated because of climate change, but then take it as fixed. Risk is fixed. What our job is to bring the best owner to the risk that already exists. So you say, it's uninsurable because of this or that. It's actually just self-insured. And then across that continuum, we bring it to RenRe capital or third-party capital. And I think what you've seen over the last few years is a rebalancing of that. So, I think from a homeowner perspective, if a homeowner's window breaks, the best owner of that risk is probably the homeowner. If the homeowner has a fire and a third of their home is destroyed, the best owner of that's probably an insurance company. And if the whole neighborhood burns down because of a conflagration, it probably comes to reinsurance, and then we figure out from there which pool of capital within reinsurance. But I think there's sometimes a sense that risk either exists or doesn't. I think what we should think about is where is risk best owned? And I think often when the government comes in or when there is a public-private partnership, all that capital's coming in and just underpricing one piece of the transfer. Where I think it's always a lot more sustainable if we can get capital that's rewarded for taking certain tranches or pieces of the risk along the risk chain.
Do you think in the US there's an argument for a federal backstop when it comes to this question that we're talking about, rather than this kind of piecemeal state by state that seems to be kind of growing, policyholders growing in these schemes?
It depends on what we're talking about there. I think a federal backstop for nuclear terror, where correlations in the products we sell kind of approach one, and with that you need to think about kind of fixed limits which will constrain supply. I think for other risks, the markets do a better job managing it. I think it's when there is such correlation in catastrophe that the government can play a role, but it should be at the most remote points and allow the free markets to trade it below.
Yeah. Orla, do you have a view on this insurability question, very much the topic of the day?
Yeah, I mean, it's back to Enstar not actually having to face into coming up with solutions to underwrite for those risks for the future. But we stay ahead of it because the insurance industry may, after a year or two, look to create capacity by Enstar in the legacy space, providing support for that. So it is important to understand it. The insurability, it is it's an ongoing challenge for all of the insurers. I think, all the best minds in the industry are working on it and considering how to address it. And I think that at the center of everything is we have a responsibility to meet the needs of society to cover these risks,
yeah.
and we'll do it. So I think.
But from your vantage point, do you think the industry has modelled this? Kevin talked about the models earlier. There is a view that some of the accelerating effect of climate change was underplayed in some of the risk models that the industry relies on, and that now everyone accepts that. Do you think it's something that, the industry didn't quite get right?
I agree with that, and I think it feeds into more of why the hardening market needs to continue, so that active players can get paid for the true risk that they're taking.
Yeah.
The vendor models have an important role to play, but we develop our own models and we price on our own view of risk. So from a climate, again, I think climate change, the change is the hard thing in trying to understand where you are on the climate ramp to a worse future state. But I believe we can manage this and we can price for it. I believe that it's not a simple thing to do, and it's different by different perils and in different regions. But it's our job. And I think what you saw last year is capital become exasperated. So capital just said that I no longer want to participate in this unless I have such a buffer margin that allows me to be confident that even if you're wrong, I'll make money. Mm-hmm. And maybe that's where we need to be for the foreseeable future. But I think capital will still be a bit skittish if they sense that the margins are becoming anemic relative to the risks that they're taking.
How do you predict the January 1 renewals are going to go? Obviously, it was a bit frenetic last year and late, and some significant price rises. It may be chaotic in parts. There seems to be the general expectation in the industry that it's going to be smoother this year, but there might still be capacity shortfall in some of the areas we've talked about, like property cat, and it might still be significant price rises. Obviously, insurers, direct insurers and households will be hoping not. But what's your take on where the industry will be?
I think the different lines of business are going to behave differently. I think it's going to be a good renewal. I think it'll be less of a shock to the market than last year was. I think there'll be new demand coming in the property cat market. I think there was demand that was not put to the market last year because the rate increases were beyond the share of wallet that they could bring to buy the new layer. So I think so property cat will have more demand coming in. That's always accretive for pricing. So just supply demand dynamics. I think some of the other property lines will be also a good rating environment for it. And then there's a lot of discussion as to where casualty is going. So I think casualty primary rates will continue to move up, and I think from a reinsurance perspective, there might be some room to improve terms and conditions within the casualty portfolios as well.
Okay, apologies because I have to ask the tax regulatory question now. But obviously, one of the big themes that we're seeing is a push from global regulators to more of a standard, whether it be tax, whether it be capital regulations, particularly, say, on the life insurance business areas where you don't operate. But I want to get your sense on how you think Bermuda, what the prospects are for this hub, given tighter tax requirements, maybe tighter capital requirements coming down the line. Will that chip away at any of the attractions of being based here? Because there's a lot of other insurance hubs, like London, where I am based. The ones are still business for me, and we'd quite like a lot of it to come back. Orla, maybe start with you. How are you feeling about the changing?
Yeah, so I think we've had a view on this for a while that it was going to come at some point, and so we're embracing that there is going to be the minimum tax implemented here. I think we're certainly here to stay in Bermuda for the long term, and so we welcome us being taxed at a Bermuda level that stops us being exposed to being taxed by other jurisdictions in a way that would be more punitive. We like the regulatory environment here. We started here, and I think being slightly different in the legacy space, the BMA really embraces us and knows our business model well. And Eva, you mentioned tighter capital regime. I think that's all good as well. We want to maintain our solvency equivalency. And so even with potentially more difficult regulatory requirements, I think the BMA is still a very commercial friendly regulator. And I think that will continue to attract business to Bermuda.
I mean, regulators elsewhere are being pushed by governments to be more friendly and quicker. It's definitely the case in the UK, where they've been very slow on things like insurance-linked securities and let Bermuda steal a huge march. And it's a question to whether they'll ever be able to kind of catch up now. But obviously, they are trying. Do you think Arthur gave some stats on the kind of market share that Bermuda holds? Do you think it's just so established now it'd be difficult for other insurance hubs to make inroads in reinsurance, in ILS, in areas where Bermuda really has
there's a lot to be said for being an established jurisdiction. There's a lot to be said for being an established company that acts in the market. So I was just talking about this with Jim at dinner last night about other jurisdictions and what are the ones that are up and coming that are attractive to move to. It is what and even with the changes here, I think Bermuda is very innovative. Whether it's the captive space or the legacy space or ILS, a lot of the new ideas and idea generation comes from here. And so whether those statistics hold, certainly from a legacy perspective, I think this is the home of legacy, and so we'll be here. And so it's probably more.
And it's raining and cold in London as well.
It's raining and cold in London. And you're not in the European
Union. I can report fresh
anymore.
off the plane. Yeah. Kevin, what's your take on this, either with the tax side, the regulatory side? It's a meaningful change that's coming down the track.
Yeah, no, Bermuda's our home. We just doubled down in Bermuda with the purchase of Validus. So I agree with everything that Orla said. I think Bermuda's a very well-respected jurisdiction. A company like us, we have locations in the other markets around the world, and we keep our holding company here because of the infrastructure and the advantages we have in working with the BMA. I think the global minimum tax, a lot of things are going to change. I think Bermuda's been very collaborative in thinking about how to implement that. I think it's smart for them to put in the 15%. I think companies here are generally supportive. If we're going to pay it, we'd rather pay it locally than have it shipped elsewhere. So now it's just a matter of kind of how the world emerges in the new 15% world. But from our perspective, I think Bermuda will remain a highly competitive jurisdiction, and Bermuda will certainly remain our home.
On the regulatory side, we had a story the other day, the IMF asking national regulators to kind of bear down on the question of life insurers reinsuring business here, the concerns about there being kind of more likely regulated environment. You definitely see that in the UK context when it comes to funded reinsurance deals. The Bank of England is very, looking more closely at where risks are offloaded to Bermuda outside of its regulatory perimeter. Is this just par for the course, the way that global regulators have always talked about Bermuda, or do you detect anything that might be slightly more challenging to its kind of regulatory advantage that you see kind of big external regulators that are trying to chip away at some of its advantages?
Bermuda has equivalents. I think there's always a healthy tension from regulators to try to think about how they can attract business to their shores. I don't see anything different. So,
good point to go to questions. Yeah, I had to push you. Okay, Annabelle, do we have any questions via the app? And if not, can people start putting some in?
No, we do. You
good.
have touched on most of the ones that have come through, but I do have one for you. As a P&C reinsurer, what is the direct impact to claims, or is the impact more on premium side as it relates to affected areas, to war-affected areas? War exclusions are usually included in insurance policies.
So Kevin, similar to what you talked about earlier. So there wasn't one particular, I don't know who asked that question. Yeah.
I'm not sure I understand the question.
As a P&C reinsurer, what is the direct impact to claims, or is the impact more on the premium side as it relates to war-affected areas?
We don't have a particularly large book in Ukraine, so it's hard. So it's not a premium issue. I think when I think about it, it's what we talked about earlier was geopolitics. And I think what one needs to think about is where areas are going to change and directionally what are going to be the tensions. I think once you're in a hot war in a region, I think it's, coverage is going to be constrained and claims will have probably emerged from policies written before the war went hot. So I think, from our standpoint, when we think about how to manage an elevated world of geopolitical risk, it's more about thinking about where things are going to change and on a forward basis, how should we be positioning the coverages that we're selling that may become exposed over time. It's not so much within the region that has gone hot.
You mentioned aviation earlier. I suppose, I don't know if this is helpful to the questioner, but at the same time, we've got the big legal fallout from the Ukraine conflict rumbling through the London courts and elsewhere as to how those losses should fall, who should bear those losses, and at the same time, we have had increases in price for that business, right? So you've everyone's trying to get a sense of how of the adequate price for risk at a point where there's a huge legal uncertainty. Is that just something where you this is, as I say, of course, for the insurance sector, there are always big legal disputes, but the mega trial, as it's been dubbed in aviation, coming from Ukraine, is a significant one in terms of the amount of losses relative to the premiums that come in, like the aviation war sector, for example. So, how much does that destabilize that market? Sorry, Kevin, keep coming back.
Again, this is back to options. Yeah. What is happening is and someone has to determine which policy is triggered from which event. And I think often what happens when there's multiple policies that could potentially respond to an issue, there's a natural tendency to look for where limits are largest. And that ultimately then creates the tension as to see if there's options within the policies that were sold that allow coverage to be either rightly or incorrectly extended into a larger limit policy. It's not new, we've seen it before. Yeah. The industry is full of issues with regard to how claims get settled. Is it one event? Is it two events from 9/11? Is it water? Is it wind? Is it? So I think it is a nature of the policy that we sell, but I think a good constructed policy should have limited ability for there to be recoveries that were not contemplated when the coverage was sold. Mm-hmm.
One of the big risks that I haven't mentioned, maybe to my discredit, is cyber. And Orla, I wonder if you have a view either on, because obviously that's one of the major threats, not only to the insurance sector, it's a question of systemic cyber risk, but also to insurers as businesses. And we've had some significant hacks of insurers and brokers, and some very sensitive data being stolen, and financial impacts too. How do you think about that risk? Obviously, top 5 for a CEO. What's your sense of that, and also the kind of cyber challenge for insurance? Because obviously that is still a relatively immature market, and one that is worried about a big attack.
Yeah. So from a market perspective, it's a constantly growing risk that it's hard to get a sense of the size and shape of what the industry is faced with trying to protect. So we are very, as I say again, staying educated about cyber, because we see in the future there's likely to be opportunities for us in that space. From a business perspective, managing cyber risk, you can never completely stay on top of it. So it's an area that we've invested further into. Our information security is, I think 5 years ago it was one person, it's now a whole team. And I think even if we think about pre-COVID, a lot of our assessment of risk from an operational perspective was more around physical offices and files and tidy desk policies. And now it's all about systems resilience and cyber and information security. So it's a challenge that we get this measure from our IT people saying you're ahead of the race and you're really doing well, and that goes to zero the next day if something happens. And you can't ever be sure that it wouldn't. And so we're constantly on top of training our staff and doing educational sessions across the business on a regular basis, and trying to catch out our senior people with doing little tests to see how they do.
See if they open any dodgy emails.
Yeah.
Kevin, you've talked about correlations, and that's a pretty major correlation that people are worried about, is a big systemic cyber attack.
Yeah.
Lloyd's ran a scenario the other day that was actually significant in the economic losses that would come from such a scenario. Other people thought that maybe that was overly pessimistic that such a thing could happen. How worried, how concerned should we be about systemic cyber?
Yeah, so we do sell cyber. We obviously, I won't talk about the operation, but we spend a lot of time making operation. We're resilient to cyber attack. If you go back 5 years, whatever, I think the dialogue around cyber has completely changed to, well, I hope I don't get hacked, to what are we going to do when we get hacked? And I think that's recognizing how prolific cyber is, and then how expectations of attack are, people feel that they're more likely to have an attack than not. From when we think about selling cyber, we try to build a diversified portfolio.
It's not intentional.
So we try to build a diversified portfolio, but we also recognize that the correlations, which I think is what you're touching on, as we think about cyber, approach 1 in the tail. So with that, there's a natural hard limit supply cap that companies are likely to look to manage their cyber limit to, recognizing that it's very difficult to predict correlations in the tail, and things will correlate much more rapidly in cyber than some other businesses.
Do you think that, not to go on about federal backstops, but it's something we've been recently looking at, some people think similar to terrorism, cyber is somewhere where there should be a governmental role, given that it can be so broad-based? Do you think there should be such?
I think if you break it down, though, but what are you protecting? If everybody, it's going to take the government to fix it if it is that broad. So they're kind of in it anyway. And I think it's as an individual company, though, you're responsible to make sure that as the world becomes back online or back operational, that you're able to participate in the economy as quickly as possible. So I'm not sure that the government needs to drop down into cyber insurance or cyber reinsurance or have a backstop. But I think if things go horribly wrong and that correlation in the tail goes to 1, there is going to be substantial government involvement to get things back online.
Yes. Annabelle, any final questions in the app? Or
Sure.
otherwise, I think we have a rather exciting poll coming up. So, but if we have any questions, we can take one last one first.
How do you view geopolitical risk in the sense of potential change in world order? Look at China working with Russia and Middle East to weaken the U.S. stronghold in world affairs.
Similar to where we started, I suppose. Yes. I feel like we've addressed that one. I don't know if everyone agrees, but yeah, it feels like...
Very carefully.
Yeah, very we treaded very carefully through that, Michael. Okay, well, thank you to my panelists. I hope we've given you some fresh ways to think about some of the big challenges facing the insurance and the reinsurance sector. And I'd like to thank you for the questions, but I'd like to thank my panelists especially for giving us their views, a lot of candor today. So thank you for joining us.
Thank you.